Good morning, traders. This is Matt with Newbie-Trader.com, and I want to welcome you to Saturday School for Saturday, September 10th, 2016. Want to talk to you today about market internals and how they can help you stay on the right side of the market and not get yourself in trouble. Obviously, yesterday was a huge down day on the market, tough day for the markets in general, but these are the type of days that we live for as short-term day traders looking for moves intraday. When we get a one-way market like this, we like to just ground and pound. And I want to review a little bit about our ultimate fractal tool in a few different markets, and hopefully just give you some insight on how to look at these environments and how to take advantage of them. Before we get started, though, I want to go ahead and jump over to a longer-term chart, and I want to kind of talk to you about key moving averages. Now, I like to look at 100 and 200 period moving averages because the institutions do. I look at both simple and exponential, but I also like the 20, 40, and 10 period. And for the last 4 or 5 weeks, we've been pretty much in a sideways pattern, and we've been forming a head and shoulder pattern. Now, this chart here is a daily chart, and we've been watching this for weeks in our live trading room. Let me just change my cursor here to a pointer. And I had given my students an opportunity to kind of see this head and shoulder pattern, the overall range we were looking at, and some of the key support areas. Well, we had been fighting with this 10 period, 20 period, and 40 period moving average for a good part of the last week and a half, 2 weeks, and we were expecting this thing to come down and test the neckline. Now, I had no idea that yesterday was going to be the day that we came in with a big gap down, and we started pushing down to the neckline, and we were going to hammer all the way through it and beyond. But we had this old retest area that goes back to June. See how back here in June, when we had some of these big down days, we made some peaks. We ultimately broke through those levels. Well, this markets like to clean up some of their old areas, and so we had been watching since the middle of June for a pullback into this area around 2120. This box had been on my chart for months and months, and we kind of had this head and shoulder pattern we were watching. Well, yesterday when we came in had the big gap down, and it was obvious we were well beneath the 40 period moving average, we were targeting the neckline. So we thought this market had a good chance to get down, test the 2150 area, and if the 2150 broke, we were looking for our next major support, which was down around 2120. And if you look, this is both the 100 simple and 100 exponential moving averages, next major area of support. So although Friday was a huge down day, we have to just kind of see what the coming days and weeks bring. We got the 100 period here. That's pretty strong support. We have this old swing pivot area from June, pretty strong support. We've made our objective on a pattern symmetry target to the downside from the head and shoulder pattern. So we have a pattern target, we have key support, we have a key pivot. So, we could start building support here and moving higher. And the market needed kind of the sell-off. The volatility had really come out of the market. We needed a jump in volatility. We had a lot of people waiting for a move like this, and there was a lot of people that made a lot of money yesterday. Although if you just, for the normal investor, a tough day. The market came off, the day before we were in that 2175 type area, and now we're at 2120. So very tough day for the investor, great day for the trader, and those that are into options, we're now happy that we have some more premium and things like that for if you're a seller of options and whatnot. So not dire straits. We're at some key levels, so we'll have to just kind of wait and see what next week brings. But let's go ahead and jump into our market internals, and let's do some education for today, because really, the internals kind of think of the market internals as kind of the underlying current of the market. I think of it as which way is the river flowing. And if you can learn to identify which way the river is flowing, and you just concentrate your trading on swimming in the direction of the current, it makes your life a lot easier. If you've ever been in a river and tried to swim against the current, or canoe or kayak, obviously going against the current is much harder. And yes, you can make progress, but it's just a tougher way to go. And the same goes with trading. If you trade with the market current or with the market internals, it makes your trades that much easier to get profit, at least to get yourself to where you have a partial profit and maybe at a break even, versus counter trend trading. Now, there are times for counter trend trading when you're in a non-trading environment, which we are a lot, but the internals will help you identify that. And let me just make one more point before we get into this. My voice, obviously we're pretty excited about the opportunity we had yesterday. But our jobs as traders is to sit here and survive. Day in, day out, the markets are chopping around. We've had a very tough summer. It's been low volatility environment. There hasn't been a whole lot of opportunity, but you have to survive. Your goal is to come in and cover your expenses each day and just make sure you have yourself there available to take advantage of the opportunity. Now, these type days, now this was a very big day, but market directional days happen only about 3 or 4 times a month in general where you get a good strong trend day. And when we get those days, we take advantage of it. That's when we like to make our hay. The other days, we're just kind of getting by. So if you're new to trading or you haven't been doing this for a very long time, just know that every day is not going to be a home run day. They come along about 1, 2, maybe 3 times a month. The rest of the time, you're just trying to sit there and bunt and bat and hit singles and doubles and stay on base and stay in the game. And that's the whole point of trading. You want to stay in the game, give yourself opportunity to take advantage of days like yesterday. So anyway, let's get into the internals. I first want to talk about how we opened yesterday. Obviously, we had a big down day. What you're looking at here is a chart of the advanced decliners, and on the left-hand side is near the open. It comes off of yesterday, so you have to kind of discount the first 20 minutes or so. But after about 20 minutes into the market, that's where I like to look at it. And you can see 20 minutes in, we are at minus 2,000 on our ADD, our advancers versus decliners. So the market is extremely negative. Where I like to look at it when it's like in that plus or minus 400 area, that is a neutral market. When you get underneath 1,000 or above 1,000, you start getting some directionality. Beyond 1,500, you don't even really want to try to do anything counter trend. Well, we opened at minus 2150, so extremely, extremely bearish. And there was no way that we can really be wanting to look at anything on the long side with that kind of open. And as you look at it through 10 o'clock, 10:30, this goes all the way up till noon, you can see the market continued to fall the whole time. So not only did it open at a very extreme minus 2100 level, it fell all the way down to minus 2600 for the first half of the first trading session. So extremely bearish. Yes, there are pockets of bounces there. You can see around the 10 o'clock reversal time, we had a little bounce on the internals. You can see around 11 o'clock profit taking time, a little bounce. That's where you're seeing the green. But you don't want to fight when it's below this minus 1500 area in general. You want to stay southward unless you get about 1,000-point move in the advanced decliners opposite that direction. Then you can start looking the other way. So right off start of the day, we're looking to be short. We're looking for any bounce we see, and we're looking to get on a continuation move, try to build a position, and then add to that position throughout the day. So that's the advanced decliners. You can do a combined chart, ADV for advancers and DECL for decliners, or depending on your data service, you might have the symbol ADD, which is a combined symbol. So that's the advanced decliners. And I also like to watch the tick, but another key one I look at is a combined chart of the up-down volume. Now, with the up-down volume, I like to watch kind of where the moving average is, and then whether the volume, if there's more inflow of upward volume versus downward volume. So this is a combined chart. I'm looking at up volume as compared to down volume. You can see the down volume when we opened up the day here around 940 was well below the average. The average is this pink line, and it's falling. Now, if we go back to the previous day, you can see the previous day we had positive. The up volume was outpacing the down volume, but we came into the market and we're down, and so we don't really want to trade against the current of the market, right? So the market's down, so we want to just stay on the south side, and you can see again, if we look through noon, not only were we below average, but we were falling the entire time. So an extremely bearish market. So you don't want to fight the volume, because if volume's not in the market, the down volume's outpacing the up volume. Again, something you just don't want to have anything to do with. So unless this volume got back above the zero line and actually was bullish, we don't want to be long at all. So we had, taking a look at which way the river flowing, we have two of our key market internal indicators, advanced decliners and up down volume, both saying don't touch this market. And then the other thing I look at is the tick, and I use this more for timing. This is how to get into trades. You can look for extreme ticks and things like that, when to take profits, but on high volatility days like yesterday, you get a lot of extreme ticks. So it's more or less a timing indicator, but you look at the zero line and you look at where you are in relationship. Again, we get over here to the beginning of the day. We start off, you can see we start off with very extremely negative ticks. We're spending most of the morning below the zero level, and every time we popped up into these positive values, that was just opportunities to work yourself into a position to get short. So not really a lesson on the tick today, but I wanted you to take from this, why you should be looking at advanced versus decliners, and why you should be looking at up down volume, and track that, and it'll help you in your trading. So, and with that, again, let's just review a few of the markets. We'll start with gold. All of the markets were off yesterday. We tracked gold, crude, and the S&P and Dow. But if we look at gold, gold probably fared the best throughout the day. Gold at least had some pockets where we were getting some long signals, but when it was all said and done, we had 6 trading signals. Now, this is our ultimate fractal signal tool, and I have it set on the alternative setting. And all these charts, I'm going to be talking about ticks and dollars. Just a point of reference, the ticks I'm referring to are based off of our signals. We don't take into account if there's any slippage involved, and we're not taking into account cost of commissions and things like that. This is just for illustrative purposes only, but I want to show you these trailing stops. They show up automatically on your chart. These arrows here, they show up automatically on your chart, and then we give you rule sets. This is the alternative setting we use here. It's more of a trend following setting on an intermediate term basis, but where you see these ovals that I have kind of highlighted, those are the signals that would be the official signal as we teach in all of our training. And the secondary arrows you see on the screen, that's where you could add to a position with if you're trying to continue trading around your original position. So think of the ovals as the official original position. Think of the secondary arrows you see on the screen as where you could add to it. Anything I'm talking about as far as ticks today, whatnot, has nothing to do with adding to a position. It's just we're talking about maybe putting on, let's say, 2 contracts. When you initiate the trade, taking a very quick partial profit, and then trailing on the second contract until your trailing stop is hit, which is again signaled on these charts, and it's part of our auto signal tool. And today I'm only talking about the ultimate fractal tool. So for gold, there was 6 trades, and mixed luck both directions really. The first trade of the day, there was a long signal because it wasn't until gold was around 8 o'clock in the morning got a long signal, and it actually was a loss because the first trade happened on the European Open. It was a good trade to the downside, but we're not up at 3 o'clock in the morning, so we had to kind of let that trade get stopped out, and the first signal after that was around 8 o'clock. It was a loser, but then 9 o'clock there was a good short that was a 31 tick winner. around 10:15, 7-tick winner. Another couple of stop outs here around the profit taking time and the market reversal time. But when we started pushing to the downside in our indexes, there was another push to the downside of gold, and it picked up another 31 ticks. So 6 trades over on the gold market. It was more rotational than the others. 57 ticks, that's the equivalent of $570 over there. So the fractal signal on gold was decent yesterday. Crude, again, there was a total of 7 trades in crude, a couple of break evens and one loser there, but ultimately crude was to the downside all day. You can see we had some nice signals. There was actually some nice re-entry signals as well, but 68 ticks over on crude, pretty much a one-directional market, and that was $680 there. Now, you're probably noticing all these red lines. Let me go ahead and explain the red lines over on the ES chart. What these lines are, and you can see a green one here. What we do with our Ultimate Fractal tool, and most of you probably already know this, and if not, just go back to our main website at Newbie-Trader.com. Over on the right-hand side of that page, there's 4 short little videos. Watch those videos because I kind of go in and explain what our Fractal tool does. But these red lines and the green lines you're seeing on here, we call that our fractal lines. And we have different times where they're active versus passive. And when it's thick, that's when it's in control of the market, and it's active. When it's thin, it's still a resistance level or a support level. It's just there means there's another level. And what do I mean by active? We're just basically tracking the swing high, swing low points. Here at Newbie Trader, we're all about trading with the direction of the trend. That's why we look at our internals. That's why, but price is king. Make no doubt about it. Price action is king. So tracking the direction of the market as it relates to pivot highs, swing lows, higher lows when you're going to the bullish side, lower highs, lower lows when you're bearish. Well, think of these red line as tracking of the lower high, lower lows, and that is the emphasis and the basis for our signals and the basis for the reset. So anyway, obviously I don't have to tell you we are in a huge one-directional market now. We were already near, if you remember, we were talking earlier about the neckline being right near that 2150 area and looking for the break. Big picture. Well, we already opened on the market here at 2160. So we were already pushing lower. If you go into the overnight session, you can see yesterday, our Thursday was a sideways day, and then they broke down in the overnight, and we had some early trading around the European Open, which was this big initial trade. This gray out area is kind of the overnight session. So we had already come into the market with a big move, and that big gap down was what set our internals off on the inside with that huge gap, because you figure we closed the previous day up around 2178, 2175 area, and then we gapped down and opened yesterday 15 points lower. So we had a 15-point gap when we've only been trading in a very narrow range the previous day of 8 points. So if you look at Thursday's range versus the open, we almost 2 times gapped the previous day's range. So it was a very bearish day. That was the first clue. And you can see, like, even during our trading session, this is one of our key moving average lines here. And we didn't even sniff that line. I mean, we were bearish from the get-go, and we just had plenty of signals. And anyway, yesterday on the ES, again, we live for days like this. We live for the direction market. Yesterday, 30.75 ES points. The S&P trades $50 a point, so that's the equivalent of about a little over $1,500. But anyway, just wanted to kind of review the markets. It was directional in all cases yesterday. We have multiple tools that we can help you with here. Ultimate Fractal tool is where we like everyone to be and start out. It's a very comprehensive tool, very factually based on market structure, and then we weave in the market internals. So anyway, I hope you got something out of this. I hope you go look at advanced decliners on your own. I hope you go look at up versus down volume, and again, incorporate it into your trading. I'll be glad to help you out with the levels and things like that where we determine to be bullish and bearish versus neutral. so you know when to range trade, when to trend trade. And anyway, swim with the current. It's much easier. And until next time, have a great weekend, everybody, and thanks for watching.